The global capital markets experienced yet another big reversal to begin the calendar year. Expectations for strong growth in the US gave way to concerns of protectionist trade policies, slowing economic data, and skepticism of some highly valued areas of the equity market. With less demanding valuations and durable cash flows, REITs performed relatively well, about up 1% in the quarter compared to equities down about 2%. Our relative performance was strong in the quarter, and we outperformed the REIT market by about 90 basis points. That brings our trailing one-year return to 6.6%, more than 300 basis points better than the index. And since we began the strategy a little over 5 years ago, we've outperformed the G-REIT index by over 600 basis points annually. That's an outstanding peer-leading result. The portfolio only invests in the best 10 to 20 real estate companies that we can find globally. Lately, we've leaned against high-flying, highly valued companies, particularly in the US, and leaned into Europe, Japan, and less cyclical companies in the US. These sectors give investors the key benefits of REIT ownership, like durable cash flows, high income, strong operating platforms, but with much higher margins of safety in their valuations. For example, REITs in the UK are at multi-decade high discounts compared to the US, and out of favor, lower growth, higher yielding REITs in the US are available, like cell towers, triple net lease, and cold storage. To show some high-level information on our portfolio positioning today, you can see this chart here, and it shows that we hold just 18 stocks in the portfolio with an attractive dividend yield of 4.7%, very strong forecasted cash flow growth of about 3.7% over the next couple of years, modest leverage of 34% liabilities to assets, a very attractive implied cap rate or implied yield on the real estate assets of the company of 7%, a significant discount to private market values or NAV of 20%, and a large discount to our primary valuation metric, intrinsic value, of 12%. We underwrite an attractive 15% annualized return for this portfolio on a 3-year hold as well, reflecting the high in-place yields and growth in the companies in the portfolio. And especially note that on our key valuation metrics like intrinsic value and expected return, our portfolio is far more attractive than the universe of G-REITs represented by the FTSE index. Then finally, on the right, you can see that about 55% of the portfolio is invested in the US, with Europe making up about 30%, and we have very good diversification across unique property types. Last quarter, I mentioned that we had the second REIT in our portfolio taken over by private equity firm Blackstone at a large premium in the calendar year. Well, in this past quarter, Blackstone bought about 20% of the assets of another one of our key holdings in the residential sector. These transactions boldly underline the attractive valuation of the companies we have in the portfolio. Otherwise, we also changed preference in the US industrial sector after seeing strong performance in our holding there and moving to an industrial REIT with higher exposure to the manufacturing hubs in the US and less exposure to markets where supply is driving down rents. We also modestly increased our position in data centers after underperformance of those companies as expectations come back down to earth for that sector around AI. We had previously reduced our position in data centers, showing that our valuation signals are working in this very dynamic market. So we think that you should look at our fund today because, firstly, REITs are under-owned and trade at undemanding valuation levels compared to equities. Not to mention that the special attributes of REITs and real estate, like attractive income, durable cash flows, falling supply levels, low leverage, and strong operating platforms, have been overlooked for the REITs for years, and those attributes could come back into heavy favor in this economic environment. Secondly, the outlook for real estate fundamentals is solid, underpinned by several dynamic real estate sectors that are enjoying strong pricing power and limited or declining levels of competitive supply. REITs are also in very strong capital positions and poised to grow their market share compared to private investors. And then third, the track record for this fund has been very strong. As you can see on the chart here, we've proven our ability to outperform in up and down markets over a really challenging period of time. with an unrelenting focus on only investing in the best opportunities we see in the global real estate markets. And we expect to continue to prove that we can help investors navigate these global markets while retaining the many benefits of including liquid real estate in your portfolios. The announcement was, I think, worse than feared. I don't think that the tariff announcements are a positive for almost anything. But I do think that given this tariff dynamic that we have to now navigate, I think that REITs overall and our positioning within the REIT market is as good as can be. We are very well positioned given this market dynamic. First of all, REITs are undemandingly valued compared to the equity market. And when you have a change in the economic outlook like this, the first thing to worry about the most is the valuation or the price that you're paying for growth. And REITs are undemandingly valued. And then our positioning within the REIT market, favoring companies that have really underperformed over the past couple of years, that don't have super high growth expectations, and are a little bit more bond-like in their characteristics, like cell towers, like triple net lease, like some residential formats that we have in the portfolio. We feel really good about those positions, and not to mention positions in Canada and Europe and things that have already taken a pretty big hit from concerns about this trade war. So I think that those are good places to hide out, get a lot of income, not pay a high price for them, and I expect us to do a heck of a lot better than the broader equity market.